Alright, boys and girls, it's 2025, and it's the year of the grifter. Grifter turned gurus, turned celebrities, grifter turned presidents. They are all thriving, right? Tortuga is overwhelmed. And in the middle of all this hype and hubris comes a contender, a financial institution that claims to print money with your savings out of thin air by simply just holding on to it, which you could withdraw as and when. We are talking about chocolate finance. Proper sounding modern fintech startup. But essentially, the reason why we're talking about this is because this is one tale of a sweet sounding startup that soured fast into a full-on digital age bank run with all the drama of a crypto meltdown. And with that, I would formally welcome you to today's episode of Brown Rice. Earlier this year, I was having a conversation with a friend of mine on the way back home from the gym, and we were sweaty, smelly, filthy, perfectly attired for a conversation about modern economics. And this friend of mine, he's a pretty nifty guy with his cash, right? We're gonna call him Mr. Krabs. So Mr. Krabs and I was in the train, and he comes closer to me and he whispers to my ears, right? He's like, come closer, let me have a little chat with you. And he was like, okay, sure, what if you could stash all your money, earn 3.3% returns a year, and get this, take it out instantly, whenever you want. No delays, no drama, instant liquidity, and superior returns, alright? And this is a big thing, because 3.3% is huge. They're competing with other big names like Endowas, that's offering up to 2.8% to 3.1%. And even them, they take a day or two for withdrawals, right? So, okay, I was like, you know what, it sounds pretty interesting. It sounds a little too good to be true. Until things got a little funky. So, aside from the marvelous 3.3% return bonanza that was going on, as well as like the instant withdrawal things, this startup over here, this fintech startup, was also offering something pretty interesting as well, which was 2 miles per dollar spent on bill payments, right? So that basically includes platforms like AXS, where you would normally pay your bills. But the thing is, people are bloody sly these days, especially these mileage goblins, right? They can sniff out a single cent. They won't let a single cent pass, because every single cent counts for miles, right? Every single dollar that you spend translates to a certain miles, and they can smell a loophole from the other room. And they realized, okay, you know what, we could just abuse this and pay a bunch of bills using this finance app, and we could just make some money out of it, make some miles out of it, right? These bloody goblins. And Chocolate Finance sniffed something was wrong. They were like, you know what, this is kind of shit. It's kind of shit. And they began making some changes on the app. And the goblins got mad. Very mad. Furious. They began withdrawing, began panicking, pitchforks were up, they were chanting names. The guillotine was set up in less than an hour, and they began withdrawing more. But here's the problem. So these goblins became furious, right? They began withdrawing, they began panicking, they began withdrawing more and more and more, and there was an issue. So as you know, Chocolate Finance was actually offering out 3.3% returns, and the only way they were actually able to do this was because they were purchasing bonds, right? Bonds that were a little bit more riskier than the usual. Bonds that were offering up a little bit of a higher return on the initial bond cost, but of course, it was a little more volatile to interest rates. And the thing is, the way these sort of bonds work is that after you purchase these bonds for a certain period of time, you get your interest on the bond that you get back in return, right? But the thing is, if interest rates are going up, the price of your bond sort of decreases. So if you're trying to sell your bond away to get your money out, where there exists other bonds with a much more attractive interest rate bond for the same amount of money that you're putting in, that your bond is worth, your bond will lose value in the market. So if you're trying to sell it away, if you're trying to get the bond out to someone else, then you gotta basically eat the losses. Does it work out? You guys get it? It's a little complicated, but I'll add a little diagram for you guys to see. That's why banks don't usually, or like financial institutions don't really have instant withdrawals, because if they run out of liquidity, they can't just start selling their shit away, because they're gonna lose everything, right? But Mr. Chocolate Finance didn't really think that's true, did you? So what happened was, upon public scrutiny, when the guillotine was up, eventually taking up losses on your own to fulfill the withdrawal requests. Until this day, the option of instant withdrawals have been temporarily terminated, which I'm sure it's going to be permanent, because there's no reason why it should be instant. I personally think that this entire thing was a clown show. I think on Chocolate's side, they could have done a little better of a job to assess their risk of to implement these sort of things, and maybe they have sort of unintentionally overpromised quite a little bit. in this whole scheme, but they've done a good job at rectifying things, which honestly, fine, you can respect that. Like, in this day and age, a bit of honesty could go a long way. And yeah, so that was today's episode of Brown Rice. Thank you very much, and I'll see you guys next week.